Let's take a breath and zoom out for a second, because what ES flashing on trading screens right now feels like a victory lap, but it might actually be the opening scene of a much bigger race. Silver in the US market is pressing right up against the $100 mark, and that number has a powerful psychological pull. Round numbers always do. Traders love them, headlines love them, and algorithms definitely notice them. Green candles, momentum chatter, historic breakout, posts everywhere. It all feels like we were watching a finish line ribbon flutter in the wind. Except here's the problem. While everyone is staring at $99 in New York, another market across the world is quietly pricing silver at something very different. Data out of Shanghai shows silver trading closer to $113 per ounce. That's not pocket change. That's a gap wide enough to drive a convoy of armored trucks through. And metaphorically, that's exactly what may be happening. A price difference like that isn't just a curiosity. In global commodities, a double-digit percentage spread between two major exchanges is a signal flare. It tells you that either one market is wrong, or both markets are about to move violently toward each other. And when physical metal is involved, convergence doesn't just happen on a screen. It happens with forklifts, shipping contracts, and insurance paperwork. In theory, the trade is simple. Buy silver where it's cheap, move it to where it's expensive, sell it, and capture the spread. If silver can be sourced in the U.S. futures linked system around $99 and sold into Asian markets, effectively valuing it at $113, that's a potential $14 per ounce gross arbitrage. On 1 million ounces, that's $14 million before costs. Suddenly, logistics departments become very interested in precious metals. Now in practice, arbitrage in physical commodities isn't frictionless. There are export rules, delivery timelines, refinery standards, transport costs, and financing considerations. But when the spread gets large enough, those frictions stop being barriers and start being line items. The wider the gap, the more problems traders are willing to solve. This helps explain why price action in the US has looked so aggressive. Big, fast moves don't always mean speculative frenzy. Sometimes they mean the market is trying to reprice in a hurry because metal is leaving. If physical silver is being pulled from exchange-linked vaults and redirected into higher bid regions, local supply tightens. And when supply tightens in a futures-driven pricing hub, the paper price has to chase reality. That brings us to inventory, the part most casual observers ignore and professionals obsess over. Warehouse reports from exchange-approved depositories show unusually large withdrawals of silver in a very short window. We're not talking about retail coin buyers. We're talking about tonnage that only institutions move. When millions of ounces exit in days, that's not decoration. That's flow. It is also important to understand the distinction between eligible and registered silver in these systems. Eligible metal meets exchange standards and sits in approved vaults, but it isn't necessarily committed to back futures deliveries. Registered metal is the category that can actually be delivered against a contract. That's the float that matters most for price discovery. Recent data shows a notable drop in registered stocks. While the absolute number still sounds large in isolation, in the context of global financial markets, it's surprisingly small. The total notional value of readily deliverable exchange silver is tiny compared to the capital that trades around it. That imbalance has always been there, but it only becomes a story when physical demand starts pressing on the structure. Here's where things get interesting. If holders of silver stored in Western vaults see a persistent premium in Asian markets, their incentives change. Instead of rolling futures or leaving metal in financial storage, they may choose to take delivery and explore selling into higher priced channels. Even if only a fraction of that metal actually makes the journey, the threat of movement can be enough to force repricing. That dynamic creates a feedback loop. As inventories decline, confidence in easy delivery declines. As confidence declines, more participants consider securing physical metal. As more metal is secured, available supply tightens further. The market doesn't need to run out in an absolute sense. It just needs to feel tight enough that paper sellers become cautious. There's also a strategic angle. Silver isn't just a shiny hedge, it's an industrial input critical to electronics, solar panels, and advanced manufacturing. Regions prioritizing industrial expansion have strong incentives to secure supply chains, not just trade contracts. Paying a premium for reliable access can make economic sense when downstream industries depend on it. Meanwhile, Western financial centers have long treated precious metals primarily as trading instruments, liquid, leveraged, and often settled in cash. That difference in mindset can produce pricing divergences during stress. One side is optimizing balance sheets, the other is optimizing physical throughput. Now, before we jump straight to apocalyptic conclusions, a dose of professional realism is healthy. Exchanges have tools. They can adjust margin requirements, delivery rules, and contract specifications. Spreads can compress from either direction. Shanghai could fall, New York could rise, or both could meet in the middle. Logistics bottlenecks, regulatory constraints, or shifts in currency can all affect the trade. But the key point is this: a persistent, wide international spread backed by measurable inventory movement is not noise. It is the market debating what silver is actually worth in a world where physical demand and financial positioning are pulling in different directions. That also reframes the $100 level in the US. Instead of being an obvious ceiling, it starts to look more like a waypoint. If another major pricing center is consistently higher, the gravitational pull may not be toward resistance, but toward alignment. Psychological barriers matter until real metal starts moving. Then psychology tends to step aside for arithmetic. Short sellers, in particular, have to pay attention. Being short in a well-supplied, stable market is a different game than being short while inventories are trending down and global premiums are widening. Risk models that worked in calm conditions can get stressed quickly when physical dynamics enter the picture. At the same time, buyers shouldn't assume a straight lineup. Volatility cuts both ways. Sharp rallies often come with equally sharp pullbacks as liquidity thins and positions reshuffle. The path to any higher equilibrium price is rarely polite. What we're really watching is a tug of war between two pricing philosophies: silver as a financial asset versus silver as a strategic material. When those two views diverge, spreads open. When spreads open wide enough, ships, planes, and contracts start closing them. So yes, $99 in New York looks exciting. It feels like history. But the more important number might be the one thousands of miles away, quietly telling us that the global conversation about silver's value has already moved on. The screen shows price. The warehouses show pressure. And when those two start telling the same story, markets tend to move in ways that make today's drama look like the warm-up act. Before we go any further into charts, vaults, and price targets, we need to pause for a quick reality check. Not about the market, but about the noise surrounding it. If you've been following this analysis for a while, you already know we focus heavily on the Shanghai premium and physical market signals. Apparently, a lot of other people like that approach too. A little too much. There's been a surge of copycat accounts lifting scripts word for word, using the same style, even the same avatar, and reposting clips across social platforms. So let's be crystal clear in a professional, grown-up, no-drama kind of way. There's only one official channel for this analysis, and it lives right here. No secret Telegram groups, no mystery WhatsApp investment clubs, no send crypto and double your silver nonsense. If someone is asking you for money in our name, that's not us. That's a red flag wearing a fake mustache. We put serious time into digging through exchange data and cross-market pricing because accuracy matters, especially when emotions are running hot. If you value that work, the best way to support it is simple. Stick with original sources and ignore the bargain bin imitations. In markets and in media, cheap copies usually end the same way, badly. All right, back to the metal, because the numbers right now are doing more talking than any influencer ever could. The core issue hasn't changed. We have a widening strain between paper positioning and physical availability. Every standard silver futures contract represents 5,000 ounces. Open interest across the exchange represents claims on hundreds of millions of ounces. On paper, that's normal. Futures markets are designed to be leveraged. Most contracts are rolled or cash settled, not delivered. The system works smoothly, right up until more participants decide they want actual bars instead of financial exposure. And that's where recent warehouse data becomes uncomfortable. When millions of ounces are withdrawn in a short span, it signals that some players are shifting from price exposure to possession. That's not a cosmetic change. That's a structural one. The ratio of paper claims to readily deliverable metal starts to matter a lot more when delivery requests rise. Think of it like musical chairs, except the chairs are 1,000-ounce bars, and the music is global arbitrage. As long as everyone is dancing in circles, no problem. When the music slows and people look for a seat with their name on it, the room suddenly feels smaller. And here's the detail that should make seasoned traders sit up straighter. Some of the largest vault operators have shown significant net outflows. When custodians, the very institutions assumed to be stable storage backstops, are associated with metal leaving the system, it suggests that large holders prefer direct control over leaving assets inside the exchange ecosystem. That's not panic, that's strategic repositioning. And why would they do that? Follow the price signals. If another major market is consistently valuing silver higher, the incentive to mobilize physical supply increases. Even after transport, insurance, financing, and time costs, a persistent double-digit spread can justify the effort. Big spreads solve a lot of logistical headaches. This is why the move toward $90 in the US isn't just another technical rally. It looks more like a catch-up process. For years, New York largely led price discovery in silver, with other markets reacting. Lately, that relationship appears to be flipping. Physical-driven pricing in Asia is exerting upward pull, and US futures are adjusting in response. Picture two connected water tanks at different levels. One sits higher. That's the market pricing silver at a premium. The other is lower. That's the discounted market. Open the valve and water flows until levels start to equalize. In commodity terms, the valve is global trade and delivery. The flow is metal. The rising water line is the price. Right now, that rising line is pressing against a very round, very psychological number, $100. Round numbers create hesitation. Traders take profits. Shorts defend. Commentators declare major resistance with great confidence in colorful arrows. Under normal circumstances, that makes sense. But resistance requires willing sellers. The question now is simple. Who is eager to sell large quantities at $99 if another major hub reflects materially higher valuations? That's why this level feels different. The usual wall of supply may be thinner than expected, leaving mostly short positioning that exists for hedging or speculative reasons rather than physical liquidation. And shorts, unlike long-term holders of metal, have a clock ticking. That clock gets louder heading into a weekend. Weekend risk is a real thing in commodities, especially when global markets operate on different schedules. If you're short and there's a significant price premium overseas, you're exposed to the possibility of a Sunday evening gap higher when Asian trading opens. You can't hedge what you can't trade, and nobody enjoys spending 2 days wondering if a policy change, export tweak, or surprise demand announcement will move the market against them. So what do risk managers often prefer? Reduce exposure? Buy back shorts? Go into the weekend lighter? That buying isn't always based on new information. Sometimes it is just based on not wanting heartburn with your Saturday coffee. This dynamic can create self-reinforcing strength late in the week. The fear of what might happen becomes a catalyst in itself. Markets don't only move on facts, they move on positioning and the desire to avoid regret. Now, about that transition from double digits to triple digits. It sounds cosmetic, but in finance, optics influence flows. At $99, silver still feels like a volatile trade to many large allocators. At $100 and above, perception shifts. It starts to look like an asset entering a new regime that can draw fresh institutional attention, not because $1 changes fundamentals, but because it changes narratives, screens, and allocation models. Retail interest often follows momentum too, though that comes with a caution. Many newer participants gain exposure through paper instruments without fully understanding the structure behind them. Price can rise sharply even while the underlying physical market is tight. But that tightness can also increase volatility. Owning exposure is not the same as owning metal, and in stressed conditions, that distinction matters. From a macro perspective, this whole episode challenges a long-standing assumption that silver is plentiful, slow, and mostly a sideshow to gold. Industrial demand growth, supply constraints, and strategic stockpiling suggest a more complex picture. When an asset shifts from being viewed purely as a trading vehicle to being treated as a strategic input, pricing behavior changes. That doesn't mean straight lines up. It means higher sensitivity to physical flows and global competition for supply. So as we head into the final sessions of the week, keep an eye on 3 things: the international price spread, exchange inventory trends, and how price behaves around that $100 threshold. If the spread stays wide and inventories remain under pressure, rallies may find support on dips. If the spread compresses sharply because overseas prices fall, that's a different story. Either way, we're in a phase where silver is being repriced not just by traders, but by supply chains and sovereign priorities. That's a heavier force than chart patterns alone. And that's why these next 48 hours matter. The Friday close isn't just another print on the chart. It is a snapshot of who is willing to hold risk when the screens go dark, the leveraged shorts hoping for calm, or the physical bulls who think the real action happens while others are off the clock. Let's focus on what really matters as the week winds down. Not the noise, not the drama, but the closing price and what it signals about risk. If silver can hold firm near $99 into the weekly close, or push through 100, that's more than a nice round number headline. A strong close at these levels forces trading desks and risk models to reassess weekend exposure. Algorithms that were comfortable leaning short in a range-bound market suddenly have to factor in gap risk, thinner liquidity, and the reality that global physical markets don't operate on a New York closing bell. Picture the situation from the perspective of a large commercial participant sitting on a sizable short position. Prices have risen faster than expected. Another major pricing hub overseas reflects materially higher levels. Inventories in key warehouses have been trending down. Now the weekend is approaching, and the question becomes simple but uncomfortable. Do you really want to carry that exposure when markets are closed and headlines can drop at any moment? Because that's the thing about weekends in volatile commodity markets. News doesn't respect trading hours. Policy announcements, supply disruptions, export rules, or unexpected procurement deals can surface while futures markets are offline. When trading resumes, prices don't ease politely from one level to another. They gap. And if you're on the wrong side of that gap with leverage, your carefully placed stop orders become historical artifacts. This is why Friday often brings short covering in fast-moving markets. It's not always about suddenly turning bullish, it's about survival and sleep. Buying back a short to reduce risk ahead of 2 days of uncertainty is a defensive move. But mechanically, that defensive buying still pushes price upward. Fear of higher prices becomes fuel for higher prices. Markets have a sense of irony like that. Now add another layer, the options market. Big, round numbers like $100 tend to attract heavy open interest in calls and puts. If price starts pushing through a strike with substantial positioning, market makers who sold those options have to hedge dynamically. As calls move into the money, they buy futures to offset their exposure. That hedging flow can amplify momentum, the classic gamma effect. It's not magic, it's math, but when it kicks in, it can feel like gravity flipped directions. So you have multiple forces potentially converging: short covering into the weekend, hedging flows from the options market, and the background pull of international price differentials. None of these guarantee a straight line up, but together they create conditions where resistance levels can give way faster than many expect. That's why the weekly close matters so much. A strong finish signals that buyers were willing to hold risk into the weekend. A weak, last-minute sell-off suggests defensive pressure still dominates. The closing print becomes a psychological anchor for the next session's open. For individual investors watching all this, it can feel like standing on a windy cliff. Intraday swings can be sharp. There may be sudden drops that look alarming, followed by equally sharp recoveries. It's important to separate structural trends from short-term turbulence. Warehouse withdrawals and cross-market spreads don't reset just because of a noisy afternoon sell-off. Physical flows operate on a different clock than intraday traders. If we do see volatility into the close, it doesn't automatically invalidate the bigger picture. In fact, fast markets often overshoot in both directions. Professionals know that breakouts are rarely tidy. They come with false starts, stop runs, and emotional whiplash. That's the admission price for participating in repricing phases. Now, let's address the psychological shift tied to triple-digit silver. Crossing from $99 to $100 may seem trivial mathematically, but perception in financial markets carries real weight. Price levels influence media coverage, investor attention, and allocation frameworks. Assets that enter a new price regime often get reevaluated by participants who previously ignored them. There's also a behavioral component. And when prices rise into new territory, some people step back, assuming they've missed it. Others lean in, seeing rising price itself as confirmation of value and momentum. In certain asset classes, that second group can grow quickly, creating demand driven as much by narrative as by spreadsheets. Silver occupies a unique space because it straddles industrial utility and monetary history. When it's cheap, it's dismissed as just another commodity input. When it gets expensive, it starts being discussed alongside stores of value. That narrative shift can influence demand patterns, especially among retail buyers who respond strongly to headlines and milestone prices. Of course, higher prices don't eliminate risk. Rapid advances are often followed by sharp corrections as leverage gets cleared out and early buyers take profits. Anyone participating in volatile markets needs a plan for managing swings, not just celebrating rallies. Avoiding excessive leverage and maintaining liquidity can make the difference between riding a trend and getting forced out at the worst moment. Looking further out, many analysts frame silver's long-term potential relative to gold through historical ratios. Those ratios have varied widely over time, and they're not laws of physics, but they do provide a reference point for how stretched or compressed relative valuations might be. If gold remains elevated and silver tightens structurally, some argue that the gap between them could narrow. That's a thesis, not a guarantee, but it's part of the broader conversation driving interest. Strategy in this environment depends heavily on individual goals. Some participants focus on trading swings and taking profits into strength. Others view precious metals as long-term holdings and think in terms of purchasing power over cycles, not just price and currency terms. Still others look at eventual asset rotation, exchanging gains in metals for real assets like property or businesses when relative valuations become favorable. What matters most is clarity. Know why you hold a position. Know your time horizon. Know how much volatility you can realistically tolerate without making emotional decisions. Markets in transition phases can be rewarding, but they are rarely comfortable. As for the immediate horizon, the key variables remain the same: international pricing differentials, exchange inventory trends, and how price behaves around major psychological levels. If spreads stay wide and inventories remain under pressure, the structural story continues. If those metrics shift, the narrative evolves. We are in a period where silver is being reevaluated not just as a trading instrument, but as a strategic material in a world of tightening supply chains and shifting monetary confidence. That kind of transition doesn't resolve in a single session. It plays out over months and years with plenty of drama along the way. So as the week closes, watch the data, respect the volatility, and keep perspective. Whether price pauses, pulls back, or pushes into triple digits, The underlying story is bigger than any single candle on a chart. Markets can move fast, but structural repricing moves in chapters, not headlines.